Good morning. It's great to see so many people joining this webinar, indicative, I think, of the high interest that this topic has for everybody. And we'll be covering how to plan for the new tax year. So if you're expecting something else, you are in the wrong place. My name's Esther Carter. I'm one of the partners at Moore Kingston Smith, and I'll be doing a bit of light chairing for today. I think probably a lot of people on this webinar are fairly familiar with who we are because there's always lots of familiar names that we see on the delegate list. But for those of you who are less familiar with who we are, Moore Kingston Smith is a leading audit, tax and advisory firm. We work with businesses across all different industries, as well as not-for-profit and private clients. And we're also part of More Global, which is an international network with a presence in over 100 countries. So as we sort of fast approach the end of the tax year, now really is sort of the perfect moment to review your tax position and make sure that you're maximising the opportunities and the reliefs that are available to you. And by sort of taking a more proactive approach, this can make sure that you sort of avoid losing valuable allowances that are available to you, help you strengthen your cash flows, and really make sure that you stay aligned with your long-term financial goals. So today we're going to be walking you through the key allowance changes that are coming into effect. We're going to provide some sort of practical guidance on how you can proactively prepare. And we're also going to outline the upcoming requirements of making tax digital. Yes, it is actually finally coming in. And we're going to be sort of covering what's changing and how you can make sure that you're fully prepared. So I'm delighted this morning to be joined by my colleagues Michelle Denny-West, who is a tax partner at Moore Kingston Smith, as well as Matthew Corgi, who is a financial planner and mortgage advisor at Moore Kingston Smith Financial Advisors. A little bit of housekeeping before we kick off with the questions. Please do ask your own questions. Please do put them in the Q&A function rather than the chat function. They're much easier to keep track of there. This is your webinar, so please do ask questions and I'll try and weave those in throughout the webinar. And any that don't get answered, we'll answer on a one-to-one afterwards. As you'll see, the session is being recorded, so please do feel free to share it with colleagues and peers who were unable to make it this morning. And a little request, there will be a little short feedback survey at the end. Please do fill that in because it's super helpful in shaping future webinars. So I think I'll start with you, Michelle. So can you just sort of give us a bit of a broad overview, I suppose, of what sort of income tax rates and allowances are going to be changing from April 2026?
Yeah, so from April 2026, I mean, the good news is the headline rates are remaining the same. So there's not been any sort of significant changes in that respect. But the downside is obviously there are some changes that have been announced and they're not going in the right direction for people, unfortunately. So from April, the most immediate change is going to be an increase of 2% on dividends. So this will predominantly affect investors who obviously just receive passive income from the investments they hold, but also business owners who choose to extract some of their income by way of dividends. The dividend allowance, which is a tax-free allowance everyone receives every year, £500 is remaining in place. But again, that's not going to do a lot for most people to actually keep them outside the scope of tax there. Also in the future, this from April 2027, we've also got an additional 2% going on property and savings income, which again isn't necessarily great news for everybody. But the positive is the savings allowance, which is the tax-free amount which people can get depending on your individual tax position of up to £1,000 per year, is remaining in place at this point in time. I think it's been in the press quite a lot that, personal allowances and the sort of tax thresholds generally remaining now frozen until 2031. So that's quite a long time. Whilst it doesn't seem like that's a big thing, this actually is something called fiscal drag, which does raise a lot of tax revenues. So essentially, if sort of wage and income inflation goes above sort of real cost of living inflation, effectively you get pulled into higher tax brackets and then end up contributing more tax revenues. So that's how that works. So whilst it doesn't sound like a major thing, having thresholds frozen, it is actually quite a big revenue raiser. As mentioned, the other rates things haven't really changed too much. That includes national insurance contributions, because I think over the last year or two we've seen quite a lot of change there as well. It's probably worth mentioning that at the start of March, we've got a spring statement coming along. We're not expecting any big tax rises in that. It should be more of an administrative thing to sort of see where we are as a country. But again, it's worth being aware that is coming. But again, as I say, we're not expecting any major tax changes there.
Thanks, Michelle. And Matthew, what allowances should we all be looking at to ensure that we take advantage of everything that's on offer?
Yeah, absolutely. Well, Very much the standard allowances. So I'm going to start with ISAs. So of course, everyone's still got their 20,000. Again, to Michelle's point, good news that that wasn't changed in the autumn statement or the autumn budget. So for a couple, 40,000. The thing I'll say is consider what we call a bed and ISA every year. So this is moving money from taxable accounts, like a general investment account, into the ISA. Bearing in mind doing that, you can still use your £3,000 capital gains tax allowance per person. Junior ISAs, those are often forgotten, but those are still £9,000 per child. So again, a really good use if you want to get money away in the tax efficient ISA wrapper, particularly if you think kids may want that for deposit, for example. Otherwise, you may want to consider a pension. We'll come on to that later. Um, Cash ISAs as well. So from 2027, those are of course reducing to £12,000 per person for under 65s. So if you haven't got a cash buffer and you want to ring fence that and put that within those ISA wrappers, you're better off doing that sooner rather than later. To Michelle's point, in terms of the 2% tax increase on personal savings, bear in mind the ISAs are completely exempt from that. So for basic rate taxpayers, they'll be paying 22%, higher rate 42%, and additional rate 47%. So, the net receipt that you get for cash savings is going to be quite low. So again, ISAs are quite a good wrapper for that.
Mm.
Pension contributions as well. So of course, from April, those are going to be included within the estate, but actually they are still very good wrappers to save into because you'll get your marginal rate of relief of tax. So everyone has got a £60,000 allowance up to, or 100% of their gross annual remuneration, whichever is the lower of those two. Everyone has also got carry forward allowance potential. So if you haven't maximised your allowance for the last 3 tax years, you can actually go back in time and utilise those. Now, bear in mind, it's a bit of a conveyor belt because you can go back to the earliest of the 3 years and then you sort of move up the line. So as soon as we get to the 6th of April, you've lost that earliest year's allowance. So it's worth going back in time as soon as you possibly can. I'm going to come on to estate planning slightly later, but for now I'll sort of keep it at that point, I suppose.
Yeah, thanks, Matthew. And Michelle, sort of thinking about just following on from Matthew's point about the capital gains tax, what's changed in relation to capital gains tax and what do we need to watch out for?
Yeah, so with capital gains tax, we're sort of in a similar position with income tax in that the main headline rates haven't changed this time around. So they still sit at 18% for basic rate taxpayers and 24% for higher and additional rate taxpayers. And that tax-free capital allowance amount of £3,000 still remains in place. But what has changed are actually some of the rates and special reliefs, which again, one in particular caught us all by surprise, I think. The first one I want to talk about is business asset disposal relief or entrepreneurs relief, I think it's previously known. So essentially, if someone sells, effectively their qualifying business, they get a beneficial tax rate upon that sale up to £1 million of lifetime gains a year. At the moment, the rate that applies to that is 14%, but from April this year, that is going up to 18%. So we are, there are, yeah, it's sort of not great, to be perfectly honest. I think for a
Mm.
lot of people, this has been their retirement pots. It's been quite an emotive thing, I think, for business owners. The other one that actually took us by surprise at the end of last year when it was announced was the change in the tax rates for employee ownership trusts. So, for those of you who aren't aware, an employee ownership trust is essentially the government's way of encouraging, I suppose, employee owned ownership of a business. I won't go into the mechanics of it because that's a whole separate webinar of its own. But essentially, what used to happen is if you had a qualifying sale to one of these sort of EOTs or employee ownership trusts, then the tax rate used to be nothing. So you paid no tax as the seller. Now, by the time you work through the numbers, the tax rate is effectively 12%. So it's still a lot lower than what you'd pay at that higher rate of 24%. But again, it's just that there is now a tax cost of doing that. So that's probably the main change I would say on capital gains tax at this point in time.
And what can sort of people do to mitigate the effect of some of these changing rates and allowances, albeit, like we say, it's been long talked about that the CGT rates would go up.
Yeah, I think on the CGT side is very much if you're selling your business or some sort of other transaction which is going to trigger that gain, if you can get it across the line before April, you are saving 4% of tax potentially on that. So it's definitely worthwhile looking at. Employee ownership trust is still worth considering in the right situations because, again, I think paying 12% tax on a, some getting value out of your business versus sort of 24% is still very much worthwhile. I would say other things you can do more around sort of the day-to-day planning. I think back to Matthew's point earlier, is that pension contributions are still very, very effective. So definitely worth looking at because, there's not very much at the moment where you can put something into a wrapper, you get an uplift that you don't pay for, and then, sort of continue on with that. What's very good thing, I think Matthew mentioned it earlier, is that for higher and additional rate taxpayers, there is additional tax relief available on pension contributions at this point in time. There have been rumours, I think, over recent sort of years and months that may well get quelled at some point, but so far that hasn't happened. So definitely worthwhile taking advantage of it if you've got the cash to do so. Also, I think gift aid contributions, so i.e. donations to charitable organisations, where you make a gift aid declaration, again, the charity gets some additional funds, which is great, but for higher and additional rate taxpayers, you can also get some additional tax relief back on that. And I think quite often, both on the pension and the charitable donation side, a lot of people do miss out on that additional relief, but you can go back up to 4 years if you've missed that and sort of correct that in the background. With those two, I would say it's, obviously worth considering for most people, but those who can particularly benefit from it are either those that earn just above that £100,000, so you're in that 100 to 125,000, 140, where you start to lose your tax-free personal allowance, can be really beneficial there. But also those who have, childcare costs to consider. So again, £100 tax-free childcare, sorry, £100, £100,000 tax-free childcare disappears. So again, making pension or charitable contributions, can you bring it back down below that to get that additional sort of tax support from the government? And also, if you get child benefits, so if you're in that higher earner of the family and you're earning between £60,000 and £80,000, which is where child benefits starts to have to be paid back to the government, again, that can be useful in ensuring you're preserving as much entitlement as you possibly can there.
With the Michelle, with the childcare, am I right thinking that sort of kind of just falls off a cliff once you tip over the 100,000? Because it's a valuable relief, isn't it? If you want to call it a relief,
It is. I mean, for those who aren't aware of what it is, so essentially, if you are paying money into what we call a tax-free childcare account, you can pay in up to £8,000 of your own money per year, and the government will top that up by up to 2,000. So you get quite a decent amount, a decent amount of value there, which you can then use to pay qualifying childcare costs. But you're completely right, Esther. As soon as you hit £100,000 or go over that limit, you completely lose it. There's no scaling down. It's just gone. So if you are around that limit, it's worthwhile looking at. And what's worthwhile being very wary of is that it's not just about your salary or your income, it's all of your income. It's, it's any, you might have interest on your bank account, some sort of passive dividends that will also count towards that £100,000 limit where you can use it.
Presumably that's just income as opposed to any capital gains you might make.
Yes, capital gains are kind of outside the scope of this,
Yeah.
A lot of people assume it's only earned income like from their job. It gets counted towards it.
But it is, interest income and the like. Yeah. Thank you. And what about if you're thinking of sort of selling your business? What do we need to be wary of there in terms of timings?
Yeah, so timings with that. If you're selling your business and hoping to qualify for entrepreneurs or business asset disposal relief, as it's now called, is trying to get that across the line before the end of the month, also before April if you can. And also actually if you've got a business where you are, it's got a lot of cash and you're thinking about closing it down, and if you've already been talking to your advisor about a member's voluntary liquidation, it could be you could get to the point where you could still benefit from some of those beneficial rates now. If you can get it across the line before April and the rates change. I think most of it is just about trying to be aware of what you can do, and if they think you can doing it early does make sense.
Yeah. So Matthew, coming back to you then, you sort of said that you touch a bit more on inheritance tax. What are you sort of advising your clients on around inheritance tax? I mean, it's a bit of a minefield, isn't it? And something I think is getting more and more firmly on people's radar with all the changes and the sort of the reliefs being frozen.
Yeah, absolutely. Well, look, to set the scene, inheritance tax is effectively the charge on wealth when it's passed from someone's estate to after death. So on this, you've got a 40% tax on anything over your allowances. So what are they? Each person has something called a nil rate band. So at £325,000 per person, you can pass on exempt from IHT. You'll also have the residence nil rate band, which is 175,000. So you add that on, and that's again for your main residence. So per person, you can have up to 500,000 each, a couple, 1 million, and that completely exempt from IHT. Now, the issue is when someone's estate for an individual or a couple is over £2 million, you start to lose one of those allowances. So the residence nil rate band, the 175 allowance, you lose that every £2 over £2 million your estate is worth. So actually, for a couple, they could end up having a combined allowance of 650,000. They can pass on free from IHT. Anything above that is subject to 40% tax. So previously, we always used the pensions as a really good IHT vehicle, and peculiarly, we would actually use that last to draw on for a lot of people for their retirement income, whereas that's very much flipped on its head now. So again, the pensions are still a very good investment tool to put money into, because as Michelle was mentioning, they're very tax efficient. They're really good for, business owners to get money out of the company very tax efficiently into that wrapper. But for inheritance tax planning, they're no longer, from April, I should say, 2027, they're no longer going to be the avenue that we sort of use for IHT planning. So because of that, it sort of switched it on its head in terms of what we're looking at doing to move assets IHT efficiently. There's two main, well, there's sort of a long laundry list, I suppose, of things that we go for ideally. In order, spending. It's a really obvious one to say, but if you spend the money, it's not going to be there and taxed against IHT. Now, the idea would be that you spend your estate to that £1 million threshold, so the full amount is passed on completely exempt. But of course, that's easier said than done. So the next piece is gifting. If you make early gifts earlier on in life, you can then avoid those IHT liabilities later on. You have allowances every year, so you can gift up to £3,000 per person, and that's completely exempt from inheritance tax. You can also gift, and it has to meet certain criteria, but a regular amount from excess income that does not impact your standard of living. Now, if you can do that regularly, those amounts are instantly outside of the estate, and there's set orders in which we record that to make sure that that's, actually going to go through with HMRC.
How sort of long before passing would you have to have regularly gifted those amounts to sort of build up that pattern?
Yeah, it's a really good question. So it needs to be displayed as regular. So if you're doing it for, say, 6 months, that might be okay. But ideally, we're aiming for about a year as a minimum. We want to see a continual pattern that it's going out, because then we've got a very robust defense if it, were to ever get picked up. So what we'll often do is we'll set up portfolios that are income generating, because it's all for that reasoning, and we have a long trail of documentation to effectively evidence what we're doing and why. So gifting is sort of the second on the ladder. We've also got protecting the inheritance tax. So let's say, you want to retain control of the asset, or you're just not ready to spend or gift it all yet. Well, actually, you can still put a life cover policy in place that in the event of death, or upon death, I should say, an amount is paid into a trust, so it's immediately outside of the estate, and then the beneficiaries can use that to redeem the IHT liability in full. Now, the benefit is, particularly if, individuals are wanting to gift their home to their children, for example, well, actually, you'd need to sell the property potentially to meet the IHT liability. So it sort of circumvents that. And then the final point I'll sort of add is we've recently had quite a nice increase in the business relief allowance. So this is a type of investment that's exempt from inheritance tax after 2 years. So it was over, I think it was the 23rd of December, when everyone was sort of wrapping up for Christmas or getting ready for Christmas. The allowance actually increased from 1 million per person to 2.5 million. So I alluded to earlier, we sort of used to use pensions as part inheritance tax vehicle. That's completely switched now. We're now using the pension genuinely for retirement and pension income, and we're using those business relief investments for the ring fencing from IHT.
Just looking at, we've got a couple of questions here. Might be worth just feeding them into you while we've got you, Matt. So sometimes somebody said, is it a good time to invest in EIS if they've got no pension allowance or ISA allowance left?
It could be. It very much depends on your risk profile as well, because EIS have fantastic reliefs, and of course they've got really good inheritance tax reliefs as well, but they are very volatile, or they can be very volatile. The question there is in and around timing. Now, with enterprise investment scheme investments, you very much have a pool of very high risk asset classes. Now, the idea is you'll have 20 assets, 20 stocks, I'll call it. 10 of them will go bust, 5 of them will do okay, 4 of them will do pretty well, 1 will do fantastically well. Now, what we often see is we want to make sure that we go into those EISs when we know that there's an NVIDIA in there still, rather than when an NVIDIA has just been, which we have seen.
Thank you. And somebody else has asked regarding cash ISAs. They said they've got a managed ISA and the platform includes cash funds. If I choose them, how is that different from a cash ISA? Hopefully you understand that question better than me.
Yeah, that's a really good question. So in short, it's just the tax position. ISAs, any of the growth is completely tax-free. Any of the interest is tax-free. Whereas the cash account, again, Michelle mentioned the personal allowances. So if you're a basic rate taxpayer, £1,000 of that cash interest is tax-free. If you're a higher rate taxpayer, £500, an additional rate taxpayer, you get no relief. Anything above that is then taxed. So the pure benefit is just that all that interest is completely tax-free within the ISA wrapper. Now, this wasn't the question, but I'm going to add into it. What we're seeing a lot more of is where clients actually, the value of the ISA is for stocks and shares, really, because all that compound growth is tax-free. You'll get a lot more growth than a stocks and shares ISA over a 5-year plus period. So what are we seeing instead? A lot of clients are using their ISA allowance purely for stocks and shares, and then money that they need in cash, relative liquidity, low risk. We're actually seeing a lot more gilts being used at the moment. And for those that don't know, a gilt is a loan to the UK government, in short. Now, the growth on some of the gilts are completely tax-free. So it's very similar to the ISA, but you retain the valuable ISA use or the allowance for stocks and shares, and you use the tax-free amount within the gilt wrappers.
You say some of the gain of the gilts, as I understand it, is actually the majority of the gain is tax-free, isn't it? There's only a small portion that ends up being called interest apart from the tax-free capital gains bit. So it is really quite beneficial.
Yeah,
Something
absolutely. And
yeah.
it's a really good point you raise. You have to make sure you pick the right type of gilt because there's 2 main types. You want something called a low coupon gilt, potentially, and it's the coupon that's tax-free. So the interest on gilts are taxable. So you want a gilt with a very low interest rate, but a high coupon or a low coupon. But the growth, the gain in the gilt itself is then tax-free.
Yeah, I would say that is anyone now who I'm seeing coming through with, high personal tax on interest, it's definitely worth speaking to you about gilts and making sure you get the right ones. It's a very, very tax efficient way of investing your money in a safe environment.
Yeah, absolutely. I mean, the final point I'll add on gilts is we tend to like to use them for, when we know we have a need for capital over a period of time. So the example could be that we want just money in cash accounts using that £500 to £1,000 allowance, and that's for emergency money, rainy day funds. The gilts would then be structured if you know you need potentially an income for a certain amount. So a lot of clients will use them for, the tax bill at the end of the year, where you've got some tax-free growth and the money's there accessible. Other clients, for example, will use it, again, gifting for inheritance tax planning, and they'll set up what we call a gilt ladder. So this is where a tranche of money becomes available every tax year, and they can use that to pay school fees, for instance. Again, very taxable, very tax efficient, I should say, and very low risk.
Well, that segues nicely into another question we've got, which on school fees, which is paying for grandchildren's school fees exempt from inheritance tax?
Again, really good question. If it's regular, comes from regular income, doesn't
Mm.
impact the standard of living, then yeah, absolutely. We need to demonstrate a history of that. And again, I sort of alluded to this earlier, but there's certain things that you can do that, certain forms, recommendations, etc. Now, if it's not, let's say that this is, you've taken the tax-free lump sum from your pension. Well, if you make that as a lump sum gift, that stays in your estate for 7 years. Now, I mentioned those allowances per person earlier, that 325,000 allowance per person. So if you make, let's say, a £200,000 gift for school fees, and you're going to pay it all up front in one go, and then you're done. Um, Within 7 years, that's still in your estate, but it will use 200,000 of that 325 allowance. It tapers over the 7 years, but the simplicity on day one, year eight, is then completely outside of your estate. So what we do a lot of as well is putting policies in place that cover that 7 year period because they can be quite affordable, quite low cost, but they cover a huge, that 200,000. Otherwise, you lose that allowance. So effectively, you've got an extra 200,000 charged at 40%. So it stops that.
A lot to think about. A very quick question on IHT. Is the rate higher if the beneficiary is overseas, or is it the same?
It's the same.
It's the same.
Yeah. The only
Super.
time, or one of the times it will change, is if you're gifting to charity. So again, IHT is 40%. If you gift, I believe it's 10% of your estate to charity, the IHT rate will actually reduce to 36%. So in that case, if you're right on that cusp, be a bit more philanthropic to say 4%.
Mhm. And what about somebody's asked me if they have a SIP pension, can they move it to avoid IHT?
So a SIP, self-invested personal pension, you can't, no, in short, you can't move it to avoid HT, but you could move it out of that tax wrapper into potentially a business relief tax wrapper, for example. So in that instance, you may want to take your tax-free cash out and you could use that as a partial investment into the business relief. That would make it exempt from HT after 2 years. A couple of other options, but yeah.
Hmm. And last question before we move back to Michelle. Somebody said, what about AIM relief?
Yeah, fantastic point. So AIM relief investments, they used to be fantastic because they had the full exemption from IHT allowance, whereas actually that's now is being halved. I believe it's from I can't remember I think it's from 2026, this April coming up.
Right.
So because of that, we're actually moving out of AIM investments again into those business relief qualifying investments.
Yeah.
The other thing, and final point for me on AIM, is that they can be very volatile. And they can take an awful long time to do well. Some do fantastically well within a short period, some take a long time. So that's the other risk to consider. You've got the same volatility risk, but you've got half the benefit now.
Yeah, interesting. Somebody, I mean, going back to the EIS point and being volatile, somebody's made a comment that several of their relatives have used EIS as an IHT saver, but all their portfolios lost money by the time they died. So yeah, it's really going to that with your eyes wide open if you're using AIM, which is, to answer somebody else's question, is the alternative investment market. So there's slightly less liquid market than the FTSE.
Yeah, absolutely.
Right, Michelle, coming back to you, give Matthew a break. So Michelle, what changes have been announced for IHT that affect business owners?
Yes, so this is probably the biggest one we've seen in a very long time, which is the change to the business property relief rules. So at the moment, for most qualifying businesses, I'm going to take here like shares in a sort of trading business or somebody's own sort of sole trade or partnership business. Typically, have been completely free from inheritance tax on death or based on any value. There's some quirks to that where the relief wasn't quite 100%, but if we just take those for now. So essentially that used to be the tax planning for people. It's very much on death. It was like, well, I'm going to die. It's going to qualify for inheritance tax relief. Job done, essentially. What is changing though from April is actually sort of touched on so individual for qualifying assets. And so that's a massive change. So beyond that 2.5 million, then the relief is dropping to 50%. So what that does, so rather than paying tax at 40% on that value, you're paying tax at 20% by the time you work through the numbers. So you get your first 2.5 million completely tax free. Anything over and above that in your state will now suffer tax at 20%, which is a massive, massive change for people. I mean, the one piece of good news which was announced, I think, in the sort of last autumn statement is that this 2.5 million is now going to be transferable between spouses. So when it's first announced, first of all, the amounts were only going to be £1 million, and you weren't able to transfer that to a surviving spouse on death if they didn't already have that for themselves. So now it's just going to transfer. So it means if you're effectively a married couple and you've got a business between you, you can get up to 5 million sort of quite effectively through on this inheritance tax side of things. But again, 2.5 million sounds like a lot of money, but I think when you've got a business that you've built over a long period of time and you're above that, this is a massive change actually, and quite not great. It's probably worthwhile pointing out as well that 2.5 million is also shared with agricultural property relief. So when these rule changes are first announced, and I think we heard saw the protests about the sort of family farm tax, it's exactly the same. It's exactly this tax relief. I just think the media focus and attention was very much on the sort of farming population rather than the business population, but it is the same set of rules.
I think you're right. I think that there was so much noise about the farming community, literal noise as I got a taxi through London and saw all the tractors beeping their horns outside Westminster, which was shortly before they rode back and put it up to 2.5 million. I think they're all getting a headache. Yeah, so much noise about the farming community that I think people did lose sight of the fact that it applied to all business property.
Yeah, it sort of went under the radar for so many people.
It did.
Quite, yeah. And I think actually this changed back, I think, on the 23rd of December, right before Christmas, to increase from 1 million to 2.5 million, I think has had slightly different media interest. So it has, I think, more people are now aware of it, which is good news. So if you've got time to do their planning.
So what can business owners that are affected by these changes do to prepare?
Yeah, so I mean, it depends on your situation really. So there's no one size fits all for everybody. But one of the easiest things to do is to actually take a step back and look at your ownership structure. So if you've got a family business in particular, and your children start to work in the business, or you think you want to pass it down to them at some point in the future, possibly looking now at making those gifts or changing the ownership at this point in time could be very beneficial. So whilst there are other tax traps to consider and think about, what this can do, provided you survive the relevant periods and everything else, that can remove quite a lot out of your estate, quite effectively, provided you survive that 7-year period that Matthew alluded to earlier. In addition, as well, a lot of people have been considering and looking at trust structures. So a trust is essentially something whereby you move ownership of an asset. So legally and beneficially you own it. So you're the legal owner, and you get the benefit of it. So you can use the income, etc. If you put it into a trust, typically what happens is you remain the legal owner via being a trustee, but the beneficial ownership passes to somebody else, i.e. it can be kids, grandkids, whoever you want it to be. So you can't benefit from that anymore. And that's essentially what a trust is. The reason trust structures can be beneficial in this sort of situation is that, so at the moment, if we go into these new rules, any amounts above the 2.5 million are taxed potentially subject to inheritance tax at 20%. If they go into a trust structure, you're within a different set of rules. And so there's ongoing tax charges every 10 years. By the time again you work through the numbers, it's an ongoing tax charge of 3% or up to 3% each time. But timing here is actually quite key, because when you settle any assets into a trust, there is potentially a tax charge on the way in. At the moment, i.e. before these rules change in April, because business property relief is currently unlimited in terms of value, you can get certain qualifying assets into one of these trust structures with no immediate tax charge. Yes, you have the 3% to deal with every 10 years, but you don't get that initial tax charge. If, however, we pass by this date in April and these new rules have come in, any amounts above the 2.5 million that go into a trust structure could suffer tax of up to 10% on the way in, being an entry charge. So again, if it's something that you've heard about, it's playing on the back of your mind, it's definitely worthwhile speaking to somebody to understand whether it's right for you, because once that date's gone in April, you're straight into the situation where you will have an upfront tax charge.
And then is there a time limit for how long the asset has to be in the trust before you're passing to sort of be exempt from IHT?
So not so much about being in the trust. The big time limit is about when you put the assets into the trust in the first place, you've got to survive that 7-year period for it to come outside your inheritance tax estate, in the same way as if you gifted an asset.
Yeah.
Once the sort of assets are in the trust, whether that's shares or whatever it might be, it's that it doesn't have to stay in there for a prescribed period of time. But obviously that asset in the trust, if you do take it out, there could be tax consequences. So again, once it's in some cases you can get it out quite easily, but other times, you do need to make sure you are taking advice and fully understanding not just what it means for your tax position now and the inheritance tax side, but actually what it means longer term.
Yeah, yeah. And then we also sort of threatened to have a little sort of rundown on making tax digital, didn't we? Which actually is definitely coming in now.
That
So
is.
people do need to prepare for it. What is it that people need to be thinking about and practically action?
Yeah, so this has been a long, long time coming, but making tax digital for individuals is here from April. We were all hoping it would get pushed down the line again because it's been kicked down the path so many times, but unfortunately for individuals, it's now here. So those individuals who will be coming into this making tax digital regime will be those who have sort of trading incomes and from their own business with the income above £50,000, and it's the income that's the important point, not the profits, and also property income above £50,000 will fall into the scope of this as well. So, and again, with the property side of things, the same thing as with trading. It's all about the actual income you're receiving. It's not your profits. I think there's been a big misunderstanding where a lot of people assume, oh, my profits are only, I don't know, £25,000 a year, therefore I'm not within the scope of it. But if your gross income's above that, unfortunately, you are in the scope. Most people should have been written to by HMRC over the last year or so to be told they're likely to be within the scope of these rules. But it's worthwhile being aware that those who are coming into the scope of making tax digital, it's based on the most recently filed tax return. So returns, Saturday was the big filing deadline for tax returns to the year ended 5th of April 2025. So it's that period which is dictating whether or not you're going into these rules. So expecting a whole other group of taxpayers or, receiving a letter sort of this month or next month to tell you might be within the scope of it. But what is worthwhile being aware of is that if you're hearing me speak today and you've got income above sort of 50,000 either on your trading income or your property income and you haven't received a letter, don't assume that means you're not within scope, because again it's down to you as the individual taxpayer to make sure you are aware of this. But what making tax digital is essentially is that from April you have to make quarterly returns to HMRC of your your income effectively. It doesn't change the tax payments dates at this point. So your tax payment dates will still be as they are, the end of January, end of July for payments on account, etc. But again, it is those quarterly reporting. And you also have an annual year-end kind of true up, which needs to be done. It's worthwhile noting as well, there's a whole new penalty regime for this if we get it wrong. But the first year, particularly for the quarterly returns, we understand it's going to be a softer landing period. So if you make a few mistakes or miss some deadlines, that shouldn't count towards the penalties. But again, one of the things here is that is speaking to your advisor to make sure you understand really what it means for you, because it's one of those situations where you have to have certain software, certain compatible software to be able to make these filings. It's not going to be as simple as, populating a spreadsheet and sending it over, unfortunately.
No, nothing's ever simple with HMRC. Matthew, quick one for you. From sort of property owners and landlords' point of views, what are the sorts of things people need to be considering?
Yeah. So at the minute, Bank of England base rate, I'm going to start there very quickly. We're at 3.75%. We expect two cuts this year. Mortgage rates are currently based on that happening. If that doesn't happen, inflation's slightly stickier, one of the base rate cuts gets pushed backwards, mortgage rates increase instantly because they're already priced in. So because of this, absolutely start the process as soon as you possibly can. When is that process? Well, it depends on what you're doing. Let's say you're remortgaging, start looking 6 months before the end of your mortgage. Absolutely. You can lock in a rate 6 months early and you lock in at current figures. If inflation is sticky and interest rates increase, doesn't matter. You've locked in your rate, you're protected, you've ring-fenced that. If, however, I'm too pessimistic and inflation is even better than we think and we get 3 cuts this year, clearly rates should come down. Again, if you've locked in 6 months beforehand, you can just follow the market down and keep reducing your interest rates up until completion. We're seeing a lot more, again, because interest rates have now come down quite a lot. Before COVID, and now it's starting to happen again, portfolio lending is actually a very good option for a lot of buy-to-let landlords. So what is it? Instead of having one mortgage per individual buy-to-let, you have one portfolio lend, one mortgage across the whole, roster of portfolios or properties that you've got.
And
What
is
this
this
means,
regardless of whether you've got them in a limited company wrapper or not?
yeah, really good question. You have options for both. Ideally, it's going to be in a limited company SPV wrapper, the lenders will call it. Um, and there are certain lenders you go to for both, but you've got options either way.
Hmm.
Now, the benefit is you've got one interest rate, one product. So you've only got one set of product fees, which, as we all know, they're usually £1,000 per mortgage every 2 or 5 years. Um, the other thing, just sort of as an aside on this, I suppose more on the personal side of things, is a lot of people aren't really aware of an offset mortgage, which can be very, very tax efficient. So again, we alluded or we mentioned earlier quite a bit about where to put money. Well, actually, let's say you've used your ISA allowance and you've put some money in gilts, but you've still got capital. You can have an offset mortgage, which in short is like having a bank account attached to your mortgage. So if you've got a £500,000 mortgage and you fund your offset facility with £200,000, as in you just put cash in there, you can access it whenever you want. You're only charged interest on 300,000 of your mortgage. So again, in today's figures, you could be saving 4%, and you're not making money, you're saving interest, so it's all tax free.
Yeah, that sounds like a good bit of planning. Right, we are nearly at the witching hour. So, Matthew, maybe just give us a little quick rundown of what the sort of key takeaways to think about from today are.
Sure, I'm going to be very succinct here. So, ISAs, use your personal ISA, £20,000 each. Consider if you should be putting it into cash ISAs or maybe somewhere else, depending on your time frame for keeping it invested. Junior ISAs, don't forget those, £9,000 per tax year. We've got until April, so I'd consider using those allowances now. Again, those allowances will refresh 6th of April this year. Pension contributions, review what allowance you have got this tax year remaining, but also the last 3 tax years. Bearing in mind you can go back in time 3 years. As soon as we get to 6th of April, you've lost the earliest year, we've moved forward. On that point, check if you've claimed all of your tax relief on your pensions. There is a type of way that you contribute, and Michelle mentioned this earlier, where you have to actively go in and manually claim that extra tax relief. If you don't, you'll lose it. Again, you can go back up to 4 years. Check your personal savings allowance and dividend allowances. Just make sure you're using those correctly. If you're going slightly over and being taxed on that, you may want to consider other options. Plan for capital gains tax and inheritance tax mitigation. Look at what the taxes are likely to be. Start making those planning decisions now. Again, use your allowances, £3,000 per person per tax year, regular gifts out of excess income. There's other allowances like gifting for weddings, etc. Speak to an advisor before the 5th of April. I'm going to say speak to your advisor this week, if not next week, not on the last knockings. But there are always, most of the time, things that we can do very early on to make, an impact ahead of the tax year end. And then finally, just be aware of any tax changes or implications that will affect you. If you don't have time to make a change now, just being aware of it, you can make that potential change before the next tax year.
Lovely. Thank you very, very much. Lots to digest there today. I think the key is, making sure you're aware of what you've got and what the changes are and how they impact you. But like you say, speak to an advisor early. Don't leave it till the end of March, because they'll be busy trying to fit you in with thousands of other people who've also left it to the last minute. Matthew, Michelle, thank you very, very much. There are a few questions left over. We'll deal with those on a one-to-one basis, a few more sort of specific questions. Thank you, everyone, for joining us on this miserable, wet Monday morning. Do fill out the feedback form. Like I said, it's super, super useful. And I think that's it. So enjoy the rest of your day, everybody. Thank you.